Welcome to CARE Conversations with Clarity Financial Solutions, where through education, we move you from confusion to clarity on all topics touching retirement. Join us as we learn and grow from others' experience on entering into the next phase of life with peace of mind and conviction that you have a team of experts to help you, educate you, and let you know your unique retirement is upon you. So it's time to take a deep inhale, a slow exhale, and walk into this next phase of life confident and with clarity. Welcome to CARE Conversations with Clarity. Welcome to my home office. I had a long day getting back after the holidays, lots of clients to care for and talk through, and just a blessing to be with all of them. But on my to-do list today was to finish a recording for CARE Conversations with Clarity. And this is a good one. So I didn't want my head to hit the pillow without finishing my to-do list. It's something that I struggle with. I really want to make sure that I get to what I have meant to get to each day intentionally. So one of the topics that touch retirement that is on most of my clients' minds is, drumroll, taxes. So taxes and retirement is something that is a misnomer, right? People think, oh, I'm going to be in a lower tax bracket when I retire, so I won't be paying as much taxation on dollars that I earn or dollars that I use in my life. And guys, that's just not true, unfortunately, right? We know that. A lot of my clients, when I do seminars and companies and associations, churches, and obviously libraries and things like that, university classes, I say, how many of you were told, defer money, put it in your 401k, put it in your IRA, you're going to be in a lower tax bracket when you retire? And I know exactly who's going to be coming up to me to meet, because those are the people that raise their hand and they shake their head. No. So we have, in this first season of CARE Conversations with Clarity, discussed Medicare, right? We've discussed how the decisions you make around Medicare can be profound when it comes to your portfolio and legacy. We've discussed long-term care, when Medicare stops and long-term care, or what we like to call extended care, starts. We've discussed Social Security and how so many people in financial services just don't understand. They put it on a shelf, they isolate it. It's like a silo, not in the plan. And then today we are going to finish out our season, this season 1, with taxes and retirement. And I'm going to start with a teaser, and I do this in my seminars because I think it's really important. And it'll get you scratching your head, right? So I get a lot of material from a wonderful resource, Horse's Mouth, which is a phenomenal educational platform for advisors like myself. They keep us up to date, on our toes, and this is one of their phenomenal presentations that they've put together. And they start this with really, a very important teaser, because it gets you realizing that, oh, you can't know that. No. This is what you have to know. So this is the tax brain teaser. I almost gave it away. We have a client, right? His name is Bill, and Bill is retired, okay? Which I love Bill for being retired and living his life. His taxable income is $48,988. Which, if you look at the tax brackets to the right, and this is obviously 2024, because I haven't updated 2025 yet, I will. The 22% tax bracket is where he lands, right? So just a few dollars over. Important point, $1 can land you in a different bracket. Now, granted, you're only going to pay tax on just that $1 in that bracket, but we're going to get to a lot of $1 differences in retirement that can really catapult you into some interesting situations and not so great situations. Now, I want to stop and say this client has $48,988 of taxable income. Okay, so what does that mean? That means the money he is drawing out of his IRA, $40,000, he's taking out of his IRA. So that's never been taxed. It was tax deferred. And he also has his Social Security income. And we're going to get to this later in the seminar, but because of his $40,000 that he's drawing from his IRA, because of that amount, his taxable Social Security is up there, right? So I know in legislation a lot right now, we're hearing people talk about no more taxation on Social Security. Great talking points, but that's not today. Today, you will pay tax on your Social Security if you're over certain income limits. In this situation, because of his income, $40,000 of IRA, $37,500 of Social Security, he wants to go see a band, right? He wants to go see, I don't know, Pink Floyd, or let's say Willie Nelson. He wants to go see Willie Nelson play, and or maybe a cover band. Who knows? Who knows where he's going to go? But he's going to go somewhere to see a band, and he needs $1,000 extra. So he decides to just get another $1,000 out of his IRA. Easy. No, guys, it's not easy. Unfortunately, because of where he took that money, it's a significant impact. But the brain teaser is, how much tax would he owe on an additional $1,000? So common sense, you and me, right? We say $48,988, which is the calculation of how much income tax how much earned income is going to land on his 1040. So we're going to go over to the tax bracket, knowing that that's the amount, $48,988. And we're going to look and we're going to say, gee, where does that land him? Well, right there in the 22nd percent tax bracket. So 22% of $1,000 is what? How much will he owe on an extra $1,000? So you would think, right, 22 cents in federal income tax for every additional dollar, $1,000, so $220. Unfortunately, that is absolutely wrong because of a complicated calculation of how Social Security is taxed. Because of where he took that money from, tax deferred, it impacted every dollar in his Social Security amount, and that increased his taxation 40.7% tax on that $1,000. Now, not on all of it, right? So it's not like cataclysmic, but 40.7% tax on that additional $1,000. So the name of this particular presentation is How Tax Planning Changes Through 4 Stages of Retirement. And I want to always encourage people. I am not a CPA. Right? I know the law, but I am not preparing taxes. I am planning for people's financial distribution phase. So in a plan, we take tax into consideration. And we have amazing software that does phenomenal testing, really beating down the what ifs to figure out the most efficient tax plan for clients, also working with professionals with each of our portfolio managers. So lots of experts when we do that. However, I want you to know, you've got to seek tax professional advice. They're the ones going to be doing your taxes every year. Their job is to save you as much money that year. That is what tax preparers do. Our job, my job, when I look at it, is to save you over your lifetime, how much, and be efficient with your tax dollars. So I really want to talk to you about three kinds of money. And I'm going to stop sharing because you probably know this, but there are three, well, there's more than three, but we're going to talk about three specific types of money in these next two episodes. The first is deferred money, tax deferred. So what does that mean? That means that I take a small deduction, whether it's my own, like self-employed, like IRA, whether it's a 401k, whether it's a traditional IRA, and I'm still working, and so I can continue to put money in there. All of these different wrappers is what I call them around this type of money means I can take a deduction if it's not a Roth, which is another type of qualified money. We're going to talk about that in just a second. I take a deduction this year. It grows tax deferred year over year over year. And then when I draw that money out, whatever amount I do draw lands on my 1040 and I have to, or my tax return, and I have to pay whatever income tax rate I am at that year on that money. So going back to Bill, because he highest level of tax was 22%, that additional $1,000 lands in that bracket. And one would think he paid 22 cents on the dollar. And we saw that is not correct. And we're going to see why. But that's tax deferred. So the way I like to think about it is the government gives you the ability to get a small deduction for that year. And everyone's happy, happy, happy. And they let it grow and grow and grow tax deferred. And then they tax us on the harvest. So not the seed that we plant year over year over year, but on the harvest, which is usually a pretty big number if we worked for a long period of time. Not to mention required minimum distributions later in our life when we have to pull money out. We don't have an option. And we're going to talk through that as well. So the second type of money is just taxable money, just investments that we have after we've paid tax on the money, we've put it into something, a stock, a bond, real estate, whatever. And that it could grow or it could go negative, right? It could decline. But regardless, there is a capital experience. When I sell that stock, bond, mutual fund, etc., and I have a gain, I pay capital gain on that amount of money. And that the percentage of my capital gain exposure depends on how long I've held the investment. And it also depends on my income. And it also depends on my age. So lots of different variables, right? So when someone asks me a question in a seminar and they're like, how much will I pay on XYZ? And I say, it depends. They're scratching their head. They're like, can't you just look? I'm like, well, if this, then this, then this, which is why you need someone in your corner helping you through it. But regardless, so that's capital gains. So taxable accounts. And then we have Roth accounts. So a Roth account is a qualified amount of money that I have saved in a tax qualified account, but because it is a Roth, I pay tax the year I invest it, but when I draw it out in retirement, it's tax-free, not only to me, but also to my heirs. Huge planning tool that a lot of people don't understand. And anybody can do a Roth conversion. We are limited in who can do a Roth contribution individually. Lots of different options. So if you, and well, you know what? I'm not going to go there right now. We're going to talk about something else right now. And I'll go down that lane of what do you think about tax rates in a little bit. So we have our types of money, right? So let's pretend we're retired and we have our lifestyle, right? We have our mortgage, our utilities, our groceries, travel, Christmas gifts we want to buy. Maybe we're paying for a grandchild's college education. Maybe we have a grandchild we're raising, right? So we have expenses in retirement, and we're no longer what? Getting a paycheck. So where is the money going to come from? Well, it's going to come from these accounts. It's going to come from Social Security, if you did indeed pay into Social Security. It's going to come from a pension if you're one of the lucky ones that still have one. It's going to come from deferred compensation. It's going to come from a IRA, an individual retirement account. It could be a traditional individual retirement account. It could be a 401k. It could be like a rollover IRA, which comes from a 401k, a 403b, lots of different, a 457, lots of different IRS codes that determine how is the government going to treat this money. But it's either going to be tax deferred or it's not. So it's a tricky world, right? Because you want to enjoy the money you've saved. I have so many clients that are petrified to draw money out of accounts because they don't want to pay additional tax, or they don't want to decline their, deplete their assets because of the legacy that they wanted to live. But most of my clients, when they're fearful, it's because they don't know the domino effect of one decision. And if they are going to draw money out of X account, what's going to happen down the road? Usually because they've been bitten. It's going to affect their Medicare premiums, or it could. What do you mean it can affect my Medicare premiums? How is income that I've saved, money that I've saved in specific accounts, going to also make me pay more for my health insurance? Well, it does. How much tax I pay on my Social Security depends on where you draw money. So if you need $1,000 to go see Willie Nelson, it's not that you can't go. It's not that you can't draw that money out. It depends on what type of account you pull it from. And we have lots of client examples where we've saved people thousands and thousands and tens of thousands of dollars because of redirecting their withdrawal from accounts. So we're going to go into it a little bit further. So let me pull this back up so we can stay on track, because I have a tendency to get off track. Y'all know this about me. So we are in a complex world. So retirement is uncharted territory, right? Most likely you planned a little bit. Hopefully you've had an advisor you've worked with step by step, or lock and step is what they call it. But if not, you are taking your head up, right? You've gone to work every day. Put your head down. You have worked, you have saved, you have prepared, planned, dreamed, hoped, and now you're there. Okay. So we have to look at different things a little bit differently, which is why at Clarity, we only focus on the retirement side. We only focus on distribution and legacy because it's completely different. So taxes in the accumulation phase, saving, versus taxes in the distribution phase, spending, completely different. No more child tax credits, no more mortgage interest deduction, usually because we paid our mortgage off. Maybe not, but hopefully so. No more tax-free employer-paid medical coverage. We now have to think about Medicare, supplement versus Advantage plan. We have to, we don't have any more contributions to 401ks, very few deductions, right? As far as what we're used to doing in, as we're earning money, as we're saving money. And now we have these new characters on the stage. We have Social Security, which is a beast. We have required minimum distributions, which a lot of people don't even know about. The government lets you, which is great, take deductions, save money. They want you to save money for your retirement outside of just Social Security. However, they don't let you keep it in the account forever unless you happen to pass before your required minimum distribution date. beginning date. Unfortunately, the problem is too, a lot of people don't realize even if you were to pass before, your heirs have mandated timeframes that they must take that money out. Paying for Medicare, just like we were talking about. How am I going to do it? Why do I pay more than my neighbor? Why does my neighbor pay nothing? What is this TRICARE for life versus CHAMP VA versus VA benefits for all of my veteran clients? And then long-term care, cracking that long-term care code, preserving, protecting, and ensuring that your money is safe or protected, isolated from complete depletion if you were to, God forbid, have a long and arduous health event that drains assets, because that type of care is expensive. Okay. All right. So we've already talked about that a little bit. We're going to develop a solution. We're not going to go through that, but we are going to talk about the 4 stages of retirement. So I've hopefully set the stage for this new uncharted territory, or at least territory that you're going to begin to have to do some research or work alongside someone to help you understand what is happening, so that you're not either scared or all of a sudden impacted by a decision you made that negatively, right? So there are 4 very distinct stages of retirement. The first one is pre-retirement. This is me. This is where I am right now. 50 to 60, I'm working, I'm saving. My kids are finally educated and they are independent contributors to society, right? So now more of my money, thank God, thank you. More of my money is going to savings, or it's going to things that I have been wanting to do for quite some time. But those little pesky kids kept asking for more money, but that's okay. I'm blessed to have them. Second stage is early retirement, 60 to 70. It's the go-go years. It's when you finally feel like you have enough saved to really enjoy what you've been wanting to do, right? So traveling, spending more time with family that may not be close, perhaps going to visit adult children that don't live with you, that have you have grandchildren. So many fun things you can do. Plus you have the mobility and the physicality to be able to do it. So we call it the go-go years. Middle retirement, 70 to 80. We call those the go slow years. And obviously when we're working with people at Clarity, we're always focused on their lifestyle and encouraging them to live the absolute best life they can through physical fitness and taking care of their health, etc. But middle retirement, so 70 to 80, going a little bit slower, right? So I have a lot of clients just retiring at 70. I had a client at the end of last year who died at 99, never retired. So it goes the gamut, but it's important to know these are kind of just the silos that we think through, and good opportunities throughout each for planning purposes. And then late retirement, 80 plus, we call those the no-go years. So we have work and save, we have go-go, we have slow-go, and we have no-go. Maybe people are coming to visit you instead of you going to visit them. And now we have these surprises. We have these really, really, I'm not going to say scary, but they can be a little scary. These surprises I can't protect people from. I can plan for, but I can't protect people from. And that is inflation. You and I have felt that significantly recently. At least I have. Longevity. I mean, I asked tons of questions about family history, not just your immediate family, but extended. But longevity is something that does have a price tag. It's a wonderful thing, but it does have a price tag. Expenses. I have clients who all of a sudden have 2 grandchildren that are now living with them, and they are fully responsible for their upbringing, right? So things happen. Expenses change. And then healthcare. If, like we said, cracking that long-term care code, if you need to go to assisted living, if you need to go to a nursing home, if you need care in the home, that care is critical for your quality of life, but it also has a price tag that is not inexpensive. And so planning for these surprises is so important so they don't rock you to your core and affect your legacy and affect your lifestyle. Okay. So one thing that we often review with people is what's the first step? So we lay this foundation for them and they're like, well, where do I start? Where do I start when I start thinking about taxes in retirement? And I say this and they scratch their head. You have to know your after tax retirement savings picture before retirement. Okay, so what does that mean? I can't tell you how many people know exactly what's that number in their account on a statement on a computer at the custodian where their money lives. And they want to make X amount. They want to have this amount saved up. They're little squirrels with all their little acorns everywhere. They want to have that amount of money before they retire. I mean, are you one of those people out there? You have a number that maybe you've already hit and now it's just over it, but while you were working, you had a number that you were looking towards. I bet you did. I really bet you did. And if you did, the question I have for you is how much is yours? And that is something that causes people to pause and say, well, what do you mean? It's all mine. I saved it. The company matched, right? Well, or I inherited it and then I invested it. That's great. But how much of it is yours? Meaning, how much of it belongs to Uncle Sam through earned income tax or through capital gains? If you were to withdraw it all today, how much are you left with? And that's a really critical thing to think about. All right, let's say you don't withdraw it all today. With your Social Security, with any other income, deferred comp, or whatever you have coming in, or pension, or some type of annuity, what's your income? And so then go look at that tax bracket. Where does that land me in tax bracket land, right? And then if I were to withdraw $50,000 more, how much of that $50,000 is going to stay with me? How much of it is going to Uncle Sam? We are in partnership with Uncle Sam. That's not a bad thing. It's just a reality. And a lot of people don't think about it. And it's very important to understand that if $1 that I have in an account does not equal $1 in my lifestyle, well, then we have a problem. And you might be thinking, well, that's common sense. But so many people do not think about this. They do not think about where they withdraw money, in what order, what kind of money is going to affect their expenses, where that money for their lifestyle is coming from. What is the total that they're going to be left with to pay those bills or wonderful things they want to do, gifting, travel, right? Giving to their children while they're still living. So many wonderful things. How much and how do I do it in the most efficient, the most effective, and the best way, right? And so this is the first step. We have to figure out how much of your money is yours. And then in what order are we going to plan for your retirement income plan? So a really important thing. So I'm going to stop right here. And I'm going to just let you guys know, we will continue this next episode. We will start going into some really wonderful scenarios, like, what if this, then this? What if this, then this? So many things that I think, for me personally, it's how I learn. I learn by watching, doing scenarios. Put me as a character in this play. Put me in this scenario. Help me figure out how to provide for my lifestyle with the money that I have in the most tax efficient way. not year by year, but as a plan. I have a map. I have my compass. I know where I'm going and why. And if I need to make a right or a left, I know why. If I'm going to pay more for my Medicare premiums in 2 years because I did a Roth conversion, I know why. And it doesn't hit me. I don't think, oh, I'm going to be paying $185 in 2025 for Part B is what an average person or the first tier. But instead, I pay $600 a month. And if I'm married, 600 times 2 times 12 versus 185 times 2 times 12. Big difference. These are things that I want everybody to at least know are out there. I can't tell you how many times I end a seminar and people are like asking me questions left and right. And then they go, well, I'm depressed. I just, you pay money the whole time that you're working, you're earning, you're paying in, and then you just keep paying in. That's right. That's the nature of our system, and it works, and it's the best government. I mean, in my opinion, I love our country and I love the way it's made, but there are ways to plan for all types of needs, whether it's a very minimum expense need and a huge legacy, whether it's a large expense need because life happens, whether it's a moderate expense need and then preparing for that long-term care. Wherever you are on the spectrum, there are amazing ways to put a plan in place where year over year you can take care of so many of those things that have you possibly scratching your head right now. So thank you for joining tonight's Care Conversations with Clarity. Thank you for hanging out with me in my home office. And I really look forward to next week walking through some examples to hopefully let you see how it plays out in real life. But if you want to engage with us, please reach out. Continue to send us what you've been sending. Thank you so much for the recommendations, the emails, the questions, the scenarios that you have want us to talk through and flesh out. That helps us craft these messages. So keep doing it. Clarity, Finn, F as in Frank, insolutions.com. And we look forward to seeing you next time on Care Conversations with Clarity. Thank you. Join our Clarity Financial Solutions family, where through education and others' experience, we empower you to make retirement choices with confidence. Follow us on Instagram or Facebook, or head on over to our website and sign up for our newsletter. If you'd like to further engage with us, please don't hesitate. Just reach out, 864-987-8729. See you next time on Care Conversations with Clarity.